Welcome to the Deep Dive, where we sift through the noise to bring you the clearest insights. Today, we're diving headfirst into the second quarter 2025 earnings call for IZEA Worldwide. And this wasn't just another quarter, it was really a pivotal moment for the company, our mission, to dissect exactly how they achieved a historic turnaround, understand some of the, mixed signals, and figure out what it all means for you.
Yeah, it's a really fascinating story unfolding here. You can see a company that's clearly undergoing a pretty significant transformation, and the numbers, they definitely reflect some bold moves by management, calculated moves.
Absolutely. Let's kick off with those headline numbers because they really do tell a compelling story of change. IZEA has achieved its very first profitable quarter ever in company history. That's a huge milestone for any company, really, let alone one in the influencer marketing space like them. Net income actually soared to $1.21 million, which, that's a dramatic reversal from the $2.19 billion loss they saw in Q2 last year.
Yeah. And this wasn't just some, accounting adjustment. Their diluted GAAP EPS came in positive too at 0 or 7 cents. And even adjusted EBITDA, which is, a key measure of how the core operations are doing financially, that swung strongly positive. $1.33 million.
Wow.
A huge leap from negative $2.19 million year over year. It really highlights this newfound efficiency in the core business.
So a really strong flip on the bottom line, definitely. Now, revenue for the quarter was $9.13 million. That's only up about 0.4% year over year, slight increase. But context matters here, right? If you actually pull out the Huzu operations they divested,
right,
their managed services revenue jumped by a much healthier 12.9%.
Yeah, that paints a different picture, suggests a cleaner, maybe more focused revenue base.
Exactly.
And clearly a more efficient one. Total costs and expenses were way down, about 30% year over year, landing at $8.40 million. Streamlining operations like that, it has a huge impact.
You can see it directly.
You do. Look at their cost of revenue drop significantly, down to 48% of sales from 57% in Q2 2024. These cost cuts, they're without a doubt the main driver behind this profitability.
Okay, but this is where the plot, let's say, thickens a little bit. Because while profitability was stellar, managed services bookings, those confirmed future contracts, they actually decreased, down to $5.6 million compared to $10.3 million in Q2 2024.
Right. So you've got this, intriguing mix, historic profit, but softer bookings.
Exactly. And that initially sent some mixed signals to investors, you can imagine.
It's definitely nuanced. On one hand, proof they can be profitable. On the other, the bookings number makes you ask about, the pace of future growth. Understanding why both these things happen side by side is really key here.
Okay, let's unpack that. That pivotal shift, this historic profitability, it wasn't just luck, was it? It came from a very deliberate strategy change and some pretty aggressive cost cutting. What exactly was that strategic shift?
Yeah, and what's really fascinating, I think, is that they consciously decided to move upmarket. They're now really zeroed in on, quote, larger, more profitable recurring accounts. And that meant intentionally pulling back emphasis from smaller, maybe one-off, less profitable projects. Think of it like shifting from chasing lots of small transactional deals to building fewer but deeper relationships, more enterprise-focused.
So trading quantity for quality, essentially.
Yes, precisely. It's a bet on maybe longer sales cycles, but hopefully much more durable, sticky revenue streams.
And on the cost side, how did they manage such a dramatic cut in expenses without hurting the core business?
Well, they definitely took a hard look at the spending. Back in Q4 2024, they made some significant reductions. That included a targeted workforce reduction, optimizing staffing, basically, and they also hit pause temporarily on some marketing initiatives. Management was pretty clear. They said they've permanently lowered our cost structure.
Yeah.
And this quarter, they're proving they can operate profitably with that leaner setup. It's a real recalibration.
Okay, that brings us back to those managed services bookings then.
Yeah.
$5.6 million for the quarter, down significantly. How did management explain that drop, especially given the positive profit story?
They laid out 3 main factors. About a third of that dip, they said, was just down to timing. Apparently, one large customer's 2024 spending was really front-loaded into March of that year.
Okay.
Whereas a similar commitment for this year, 2025, actually got booked back in Q4 of 2024.
So the business was still there. It just shifted when it hit the books for comparison purposes.
Exactly. It wasn't lost business. It just skewed the Q2 year-over-year number.
Got it. What were the other 2 factors?
The second one ties directly into that strategy shift we just talked about. Because they were intentionally moving away from less profitable accounts, They simply didn't put as many internal resources towards chasing those lower value deals.
Right, a conscious choice.
Yeah, prioritizing quality and strategic fit over just hitting any booking number.
And the third factor. Sounds like it might be broader.
It is. Macroeconomic headwinds, something a lot of companies are feeling. Management pointed out that several customers paused marketing budgets. Why? Broader economic pressures, tariff uncertainties hitting certain industries.
So external factors impacting client spending, not just specific to IZEA.
Precisely. A challenging environment out there.
Okay, but despite that dip in Q2 bookings, they did mention a strong and growing pipeline and a managed services backlog of about $11.5 million as of June 30th. For listeners, maybe quickly explain backlog and how fast does that usually turn into actual revenue for them?
Sure. So backlog is basically contracted work that hasn't been done or recognized as revenue yet. Think of it like future revenue already signed, just waiting to be delivered. For IZEA, typically, these booked amounts convert into actual revenue over roughly, say, 6 to 7.5 months. Some might stretch out to 12 months. So yeah, while Q2 bookings were softer, that pipeline and the existing backlog still give them some visibility into future revenue.
Good context. Now, beyond the income statement, there's another really crucial piece here. That balance sheet, it looks rock solid.
Oh, absolutely.
They've got $50.6 million in cash and investments, and importantly, no long-term debt. That gives them enormous flexibility.
It really does. That kind of cash position provides significant optionality. You don't always see that in companies this size. And they're using some of it. They're continuing their stock buyback program. There's a $10 million authorization. They've already bought back over 500,000 shares for about $1.3 million through early August.
And that included a Dutch auction tender in June, right?
Yeah, exactly. Which is basically a way for them to buy back a good chunk of shares efficiently by letting shareholders offer shares within a price range. They pick the lowest price that gets them the shares they want.
Smart. And with all that cash, are they hinting at anything else? Maybe M&A to speed up this strategic shift?
Yes, M&A is definitely on their radar. Management mentioned they're actively looking at opportunities. But, and this seems important, they stressed a very strategic and choiceful approach.
Meaning
They're prioritizing deals that are accretive ones that add to earnings per share right away, and they're focused on integration readiness, making sure they can actually absorb what they buy. They specifically said they are not chasing deals or overpaying.
So disciplined, not just buying growth for growth's sake.
Seems that way. Disciplined capital allocation.
Okay, shifting gears slightly. Innovation. It's critical in this space. Influencer marketing moves fast. What are they doing on the product and tech side?
Yeah, they're definitely focused there. Mention ongoing enhancements to workflow, better analytics, also boosting their TikTok API integration, which is essential.
Absolutely.
And significantly, they've kicked off a new tech initiative. This is aimed at enhancing their main campaign management product and crucially injecting more AI into their business processes.
AI. Everyone's talking about it.
And for good reason. It's vital for staying competitive, boosting efficiency, and frankly, for landing those larger, more sophisticated enterprise clients they're now targeting.
And it sounds like they're investing in people too, not just tech.
They are. They recently hired Cecilia Peralta as their first ever VP of talent acquisition.
Interesting move.
Yeah, it signals a real proactive focus on attracting top talent, leaders, and elevating their brand as an employer. Not just hiring marketers, but building the team for this bigger strategy. And they also added an EVP back in July, so strengthening the leadership bench too.
Okay, so pulling all these threads together, profitability, the bookings nuance, strong cash, innovation push.
Yeah.
What's management's actual outlook after this transformative quarter?
They termed it constructively bullish, which, suggests optimism, but grounded in reality, aware of the market dynamics.
Right, not getting carried away.
Exactly. They didn't give specific number guidance for revenue or EPS, but they did say they anticipate gradual OPEX increases to support growth. OPEX, operating expenses, will need to rise a bit. But the key phrase was they expect to achieve profitable growth over the next 12 months.
Okay, profitable growth. But how do they balance that? They mentioned growth could be uneven. How do they maintain profit if growth sputters?
Discipline. They really hammered that point. The goal is to make sure expenses only grow alongside revenue. Keep things in parallel. Acknowledging growth might be uneven really underlines that continued focus on tight cost control. It's like walking a tightrope, right? Invest for growth, but keep that hard-won profitability intact.
Makes sense. So For you, the investor listening, what's the core story here? It really feels like this shift, prioritizing quality and profit over just the quantity of revenue, is the central theme.
Absolutely. Moving towards that enterprise relationship-driven model.
And if we zoom out a bit, the broader sector, communication services, the XLC ETF, has done pretty well over the past year. So maybe there's some tailwinds.
Potentially, yeah. Some positive sector vibes could help. But this earnings call also really highlighted specific micro challenges, those customer budget pauses, the macro uncertainty, tariffs. You really need to weigh those broader tailwinds against these specific headwinds IZEA mentioned.
Which brings us to the big question, I suppose. Will that strong and growing pipeline actually turn into better bookings in the second half of the year? Will it validate this strategic shift? Prove the profit is durable?
That's the million-dollar question, isn't it? That's what everyone's watching.
So, key things for you to keep an eye on. Those H2 bookings trends, definitely. How fast the backlog converts to revenue. Any potential smaller tuck-in M&A deals.
Right. And the rollout of those AI features they talked about, plus the pace of the share buybacks and just the overall market mood, the risk appetite for stocks like this.
The core narrative seems to be a leaner IZEA, now profitable, coming out of restructuring. The challenge now is proving this profit inflection point isn't a blip, that it's sustainable as demand hopefully normalizes. Okay, let's switch gears for our final segment. Let's talk about a provocative, maybe even a bit wild, investment perspective based on all this. And just a reminder, this is purely for entertainment and informational discussion, definitely not financial advice.
Got it. Lay it on us.
All right. So the setup is pretty compelling, right? First profitable quarter ever. Over $50 million in cash, no long-term debt, actively buying back stock. Management sounds positive, constructively bullish, clear strategic pivot to higher quality revenue, and yet the market reaction after the call. A pullback, seemingly focused on those softer short-term booking numbers.
Yeah, it does seem like the market might be focused on the immediate number, maybe missing the bigger strategic picture they laid out.
Exactly. So here's the perspective, the trade idea. What if you consider that the market's negative reaction is an overreaction, an overemphasis on temporary bookings, softness? Softness that management explained pretty clearly with timing, strategy shifts, and macro factors, not, a collapse in demand.
Okay, so you're betting the explanation holds water.
Right. And if that strong and growing pipeline does translate into much better bookings and revenue conversion in the second half, and if those AI initiatives start showing results, well, the market could suddenly re-rate this company. Newly profitable, cash-rich, strategic pivot, validated.
So the outrageous part isn't necessarily the bet itself, but the timing and conviction.
Kind of. It's the conviction that a microcap company can prove its profit turnaround is durable quickly, and that a cautious market will recognize this value shift much faster than expected.
Leading to maybe substantial upside. You're essentially trying to front-run the market's eventual aha moment about a sustained turnaround.
It's definitely provocative. Betting on a rapid narrative shift, what are the big risks there? What could trip this up?
Well, the obvious ones. Those macro headwinds could get worse, delaying spending even more. The pipeline might convert slower than hoped. Execution risk is always there with big strategy changes. And for a microcap, sentiment can shift really fast, both ways.
True. High risk, potentially high reward scenario if the thesis plays out. Precisely. Okay, so let's wrap this up. What does it all really mean? IZEA's Q2 2025 was undeniably a pivotal moment. They hit profitability through smart cost cuts and that refined focus on better clients. Bookings are nuanced, yes, explained by strategy and macro stuff, but the balance sheet is strong. The outlook is optimistic, albeit cautious.
Yeah, and here's what's really interesting now, I think. IZEA is basically asking investors, look past this one quarter's bookings number. Trust our long-term strategy. Trust this profit is real and sustainable. It really is a test of belief in their strategic vision, isn't it?
It absolutely is. And it raises broader questions, too. What does IZEA's journey tell us about that constant tension between short-term numbers and long-term strategy shifts, especially in dynamic markets?
Yeah.
How fast can a company really change its story in investors' eyes, particularly when it involves deliberately trading volume for value? Lots to think about there. We definitely encourage you to continue your own research and consider these dynamics. Thanks for joining us on The Deep Dive.